Well, first of all, these near-term moves, a buck, $2, $3, they're noise. They're not music. Um, that's just the first thing to know. I don't know if you remember this, but I remember one of the first interviews that you did. You were expressing your viewers' frustration that gold couldn't crack through $2,000 an ounce. I don't know if you remember this, but I think gold was 1,800 or something like that. And I said, you know what, Daryl, I don't own gold for a $200 or $300 move. I don't move. I don't own it because I think it might go to two. I own it because I think it might go to nine. And that's how I feel about silver. To me, the difference between 36 and 34, mixed knocks. I came into the silver market in 1970 when it was a buck 20 an ounce. At the end of the decade, it was $50 an ounce. When you see a silver bull market, silver is much more volatile than gold. I don't know why it is, but here's what I know about silver. A precious metals bull market is led by gold, and the price momentum is established by gold. And when the price momentum validates the narrative around precious metals for the generalist investor, not the precious metals investor, but the generalist investor, the Fidelity guy, the Vanguard guy, pardon me, when that guy comes into the market, for whatever reason, perhaps because of the lower unit costs that silver has relative to gold, they crowd into the silver space. And when they crowd into the silver space, traditionally, there hasn't been enough market cap in the silver silo to handle the money that comes in. And it doesn't go up, it explodes. By the way, you're not going to need Rick Rule to tell you when that happens. You're not be anticipating a 35, 36, $37 move. Uh-uh. Uh-uh. The three times in my life, the gold price has escalated by 10 times or more. I'm not saying it's going to escalate. I'm not saying it's going to go to 300. But if I'm right about the gold price, which is to say that the gold price could go up three times from here, the silver price can do more than that. When it's going to happen, I don't know. And you know what? At age 72, I don't care. I'm a healthy 72-year-old. I'm going to see it. I'm going to see it with my faculties intact. I'm going to enjoy it. I'm not going to enjoy the reasons for it, but I'm going to enjoy the thing. So it'll take care of itself.
Hmm. Yeah, and just thinking about that, I think there's still, I mean, it's opportunity in both, but I don't buy gold for like the upward movement. I put that capital into like the royalty and streaming companies and such. I buy gold for the purchasing, for the
Right.
preservation of my purchasing power and hedge against chaos. But silver, like there's still some opportunities there. I mean, especially considering that it isn't at the it isn't at the all-time high, and it could, go up at least 2, 3x, and
There's
so
a huge speculative opportunity if you can stomach volatility and if you can wait. One of the things I've noticed, Daryl, as you know, I've graded tens of thousands of portfolios. Anybody who wants can go to ruleinvestmentmedia.com, list your resource stock portfolio, I'll grade it. And one of the things I've really truly learned is that while a lot of people get the strategy right, they say the price of gold has to go up and the price of silver has to go up more. Uh, and that could be a 3 year or 4 year or 5 year phenomenon. So they get the strategy right, but they get the tactics wrong. They're afraid to hold the asset class over a long weekend when they're taking on a 3 to 5 year strategy. Or they think that what they want matters. Okay, I got my silver position. Now it needs to go up by Thanksgiving. You think the silver market cares what you want? You know, so people got to wrap their heads around this. I absolutely positively believe that in a nominal sense, the silver price at least triples. At least. When's that going to happen? I don't know. I have no way to know. Um, so I don't seek to know. I just know that when it moves, it really, really, really moves. I can psychologically and financially afford the risk to wait. And the volatility doesn't bother me at all. If it goes to 36, I'm not excited. If it falls to 33, I'm not depressed. Like we said at the beginning of the discussion, that's the difference between music and noise. You know, uh, those little moves are just noise. $100 silver, no, that's more like music.
mhm.
Let's look at history. Okay. The last time we had a period of rapidly declining US dollar purchasing power was the 1970s. In the 1970s, the US dollar lost 75% of its purchasing power, and gold ran 30-fold. 30-fold. Okay. Now, I'm not suggesting the next 10 years the gold runs 30-fold, but I am suggesting in the next 10 years that gold loses 75% of its purchasing power again. And well, I don't know, and you've been interviewing me long enough to know I don't know. I suspect that the increase in the gold price will mirror the deterioration of the US dollar, its purchasing power. That means that gold should rise threefold or fourfold. Let's say I'm wrong and it doubles. That's not a horrific outcome. And armed with that knowledge, which is to say at least the nominal price of gold rises for 10 years, that meets the definition of a gold bull market. And gold bull markets follow predictable patterns. In the early stages of a bull market, what moves is gold, not the gold stocks. When you first started interviewing me, you expressed your viewers' frustrations that gold was moving, but the gold stocks weren't. And the explanation I gave to you is, first of all, this is the way history works. But secondly, one asset class, gold, had a buyer, foreign central banks. And foreign central banks don't buy gold stocks. So if one asset class has a buyer and the other asset class doesn't, of course the one that has a buyer goes up. And that's what happened. Like earlier bull markets, the momentum established by gold eventually spills into the gold stocks. It does that for two reasons. The move in the gold price validates the narrative to investors. They get interested in gold as a topic. But the second thing that happens is as the gold price increases faster than the input cost to produce it, the companies make more money. And we've seen that just in the last 15, 16 weeks. We've seen solid inflows into gold ETFs, and the buying has been concentrated in the best of the best, the Wheaton Precious, guys like that. When that momentum establishes itself, courage and cash goes down the value chain. And that is what you saw in gold royalty, and that'll continue. I think not. And I don't think of gold in isolation. I think it in juxtaposition to the US dollar and the real US dollar interest rate. The best way to answer that question, Daryl, is gold fully priced, is what set of circumstances would cause me to sell my gold? How would I identify it as overpriced? I own gold because I believe debt and deficits in the US are out of control and will lead to the deterioration in purchasing power of the US dollar. So what would cause me to sell my gold? Well, the first would be a balanced federal budget. We're $2 trillion out of budget and getting worse. The second would be a sane fiscal plan for dealing with $100 trillion in net present value of entitlements. We're a long way from there. The third would be declining real interest rates. And that's tougher to explain. A real interest rate is the plurality of the 10-year Treasury yield to the underlying rate of inflation. And this is the subtle part. Right now, if you believe the CPI, you believe inflation is 2.5%. The US 10-year Treasury rate is 4.5%. So you're getting a 200 basis point real yield. But if you believe, like I, that the underlying rate of inflation is 7.5%, you're getting paid 4.5%, it means that you have a minus 3% real yield. So for me to sell my gold, I would have to have a 200 basis point real yield to underlying inflation, which is to say that the US 10-year Treasury rate today would have to be 9.5%. If that's true, the first mortgage rate would be like 11%. If you look at all of that arithmetic, but particularly the real interest rate differential, you see that from my point of view, the reasons for me to own gold are very much intact. I'm not expecting gold to increase in price in real terms in the next 10 years, although it might. It might be because of the human psychology you talked about. It might be because it might be that the increase in the gold price causes people to overvalue the narrative and they buy too much. But all I'm counting on is that the gold price will mirror in nominal terms, the deterioration of the purchasing power of the US dollar. It will maintain its purchasing power today in a currency that declines by 75%.
Gold and silver have once again captured the spotlight as America teeters on the edge of unprecedented financial and political instability. With Donald Trump's recent surge in polling numbers despite multiple legal challenges, and the U.S. economy walking a tightrope of inflation, rate uncertainty, and record-breaking debt levels, it has become abundantly clear that the fiat system, rooted in endless money printing and blind trust, is broken. Gold and silver are not just alternative investments anymore. They are lifeboats in a storm of economic and institutional collapse. Every fiat currency in history has eventually failed. The US dollar, once backed by gold, now floats on the whims of policymakers and central bankers. The Federal Reserve claims to fight inflation, yet it created the very problem with years of near-zero interest rates and trillions in stimulus. And now, with CPI inflation numbers still sticky and consumer sentiment in freefall, they've cornered themselves into a lose-lose situation. Raise rates and tank the economy, or ease and ignite another inflation wave. Either way, fiat suffers, but physical gold and silver, finite, real, and time-tested, thrive. In the last few weeks, silver has quietly outperformed many other assets, pushing past key resistance levels while being largely ignored by the mainstream media. Gold, too, is testing all-time highs amid global central bank accumulation. Why are nations like China, Russia, and even Poland buying tons of gold while telling their citizens to hold cash? Because they know what's coming. They know the dollar is losing its dominance and that the next financial system won't be built on paper IOUs. It will be anchored to something real. Trump's return to the headlines isn't just about politics. It's about economic sentiment. His recent statements slamming the Federal Reserve and calling for a return to sound money are echoing louder than ever. Trump understands that Americans are losing faith in the institutions that manage their money. Confidence in the Fed is near all-time lows. The Treasury is issuing debt at a breakneck pace. Social Security is on track to go bankrupt. Meanwhile, the stock market continues to float on speculation, artificially supported by Fed jawboning and tech hype. But beneath the surface, cracks are forming, young investors are waking up. They're beginning to see the trap. Save in dollars, and you're guaranteed to lose purchasing power. Trust in stocks and crypto, and you're subject to manipulation and regulatory whims. The only assets with a 5,000-year track record of preserving wealth through every war, recession, and regime change are gold and silver. And right now, silver is arguably the most undervalued strategic asset on Earth. Not only is it a monetary metal, but it's also essential in solar panels, electric vehicles, and industrial applications. The supply is shrinking while demand is surging. This is not a speculative narrative. It's a supply chain reality. Meanwhile, America is sleepwalking into another debt crisis. With over $34 trillion in national debt and interest payments now rivaling military spending, the writing is on the wall. The government has no plan to pay it off. The only tool they have left is inflation. Silent theft through currency debasement. If you're holding dollars, you're the victim. Every printed dollar makes your savings weaker. Every stimulus check, every bailout, every new government program funded by the printing press, it's a transfer of your wealth to the state. Look at the banks. Regional banking stress has returned, and big names are warning of a new wave of collapses. If even one major institution falls, a domino effect could ensue. And with FDIC reserves under pressure and trust in banks declining, people are beginning to ask serious questions. What happens to my savings if the system locks up? If you can't hold it, you don't own it, and that's why physical metals are making a comeback. Gold and silver require no counterparty. They cannot be hacked, frozen, or inflated away. They don't rely on government promises or Wall Street gymnastics. In times of war, regime change, or collapse, like the world is inching toward now, they are the final fallback. Just this week, Trump warned that America is closer than ever to losing the dollar as the world reserve currency. That's not alarmism, it's fact. The BRICS nations are actively developing a gold-backed trading currency, and the world is watching. The petrodollar era is ending, and with it, the dollar's dominance. Gold and silver will outlive fiat. They have outlived every empire that thought it could print its way to prosperity, and they will outlive this one too. While Wall Street distracts you with AI stocks and debt-fueled bubbles, the smart money is quietly accumulating hard assets. If the monetary system resets, and history shows it always does, those holding metals will have purchasing power while everyone else scrambles for crumbs.